Hello and welcome back to KD's Business Tips. Michael Lapete here in a small mini-series talking about trusts and maximizing the use of a family trust. And in this video, we're going to talk about the maximizing of getting your assets out of a trust. Now, when we look at liability and passing on assets to the next generation, these are key factors of a trust, right? Estate planning, liability protection, as well as tax planning. Those are kind of the key areas of a trust, but another area of planning with a trust is the cash flow. The cash flow, what comes in and goes out, of course. And with a trust, when you flow through income or assets, typically with income, it will retain the same characteristics when it's received by the beneficiary. So if it's a dividend coming in, it will be a dividend going out. If it's an eligible, non-eligible, non-qualifying, capital dividend, whatever type of dividend it is, it will retain that same characteristics. If it's business income or capital gain or whatever it is, it will flow through the trust to the beneficiaries with that same characteristic. Very important. Now, the trust can also give loans. So first of all, we can bring money into the trust by, obviously, through income, right? So income source that we just talked about, capital gains, interest. If it owns shares in companies, maybe shares in your company or shares in a public corporation, it could be any of the above. It may sell assets, cryptocurrency, gold, silver, properties, and gain capital gains. That's another way, right? But also we got to look at the end of the day, we can get money in there by loaning it as well. So if we don't have any income going to the trust and we want to get income, we can loan it. Now there are special rules of a loan to a trust. You must have prescribed interest rate at minimum, okay? And that's typically around 1 to 2%. It's been floating. It's been 1% a long time, recently been increased. And it has to be at that prescribed interest rate, and that interest must be paid 30 days after the year end, which is December 31st. So January 30th, by the following year, that interest should be paid, or you could run into problems with what's called attribution. I won't cover that here. It's another video. But that's very important. Now, when you set up a loan, it's documented. There's the interest rate of a minimum prescribed rate, and the actual interest is paid every year when loaning to or from a trust. Now, another way to get money out is, of course, the trust can give that loan, but it can also pay maybe a trustee fee or an employee to be able to do work for the trust. Typically, it's going to be a trustee fee, and you're going to pay that fee out of the trust to get money out of the trust. That's another way we can get money out of the trust. Another thing we can do for the beneficiaries is we can pay for tuition and education to post-secondary schools. And that will be, of course, recorded as income to the recipient, the beneficiary, but then also we get the tuition deductions too as well, the tuition credits to be claimed against that income. So a trust can also distribute to pay for school. Now, the other way we can look at is we can look at income splitting too as well. So income coming in, but also income splitting. So we can split business income, investment income, capital gains. We can multiply that capital gains exemption, which is really, really key, and even multiply maybe the small business deduction by setting up multiple entities, multiple trusts. But the key there is tax planning, because there's other rules such as tax on sprinkled income, what we call TOSI, there's section 55(2). There's all these other rules that come into play potentially in your structuring and splitting income. But again, it is okay to split income as long as you fall within the rules. And that's another key factor of the trust. Now, we got to be careful though of splitting income to minors, because there's something called kiddie tax where the minor will pay one of the highest tax rates. We can also give assets out of the trust to the beneficiaries. So we can take the assets of the trust and distribute it as a distribution to the beneficiary. Now, some is going to be taxable. Of course, if it's before tax dollars, anything before tax that hasn't been taxed yet, it's going to be before tax. Anything that's been taxed already, that's called capital, and the trust can do a capital distribution that's tax-free. Okay? And we can also, for larger assets, we can do a tax-deferred rollout of the asset to get the assets out of the trust as well. And if a rollout is used, though, we may have to close the trust, though, depending on the situation, or potentially maybe that beneficiary would no longer be a beneficiary. So there's ways to do it, but certain circumstances and certain things have to be planned. So again, we can do income, loans, distributions for school. We can distribute for assets. We can use income splitting. There's lots of ways to get assets and money out of a trust. If you have any questions, we'd love to hear from you. And do post in the comments below. Thanks for being a part of our business tips, and we'll see you in the next video.